Wall Street taking a breather after a recent run-up in the S&P 500 brought that index into striking distance of its old record set back last fall. Well, is this a sign that the market has gone too far, too fast? Well, joining me to discuss the outlook is Chris Constantinos. He is the Chief Investment Strategist at RiverFront Investment Group. So, Chris, what's happening to the market today?
Well, I think today it's just trying to digest, right? It's exactly like you said earlier, Conway. Market is close to all-time highs. It's close to that 2850 level where it's failed, last count, probably the last 6 times it's tried to break through. So you know, between here and the old high around 2940, there's a fair amount of resistance. So we see in the near term, probably market consolidation, nothing better than that.
So I know from your note you said to fade the S&P 500 above 2,800. Right now we're at about 2,865. So what prompts you to make your next call, your next buy? Sure.
Well, we'd want to see one of two things. The first thing is in this digestion phase that we're talking about, if markets move back down, let's call it, somewhere in the 26 to 2,700 range, we would view that as excellent value because our long-term prognosis is still pretty constructive on markets. And by the way, if you have a long-term investment horizon, you could probably ignore everything I'm saying because we still think stocks are a lot better value than bonds over the next 5 to 10 years. But again, if you're a lower risk investor or if you have a investment horizon less than 5 years or so, you should probably be more of a buyer down on the 2,700 level. The flip side to that is if the market decisively breaks above 2,950, we would say it's probably somewhere north of 3,000, and that comes with positive earnings revisions. So therefore, the market multiple looks a little bit more reasonable again. I think that's that would be a decent sign to buy as well if you're a momentum investor.
So you brought up earnings revisions. Just today we got a zinger from Walgreens Boots Alliance, basically saying that it was the worst quarter that it saw since the merger, and it was blaming macro trends. So how concerned are you about the earnings season as now we're in the time when companies are going to start reporting?
Well, if you were looking for a reason for the market to stall out here, earnings season would probably be a pretty decent one. The good news is, like we said, earnings revisions have come down. The bad news is that the stocks haven't, right? So we've had a pretty tremendous run here in the first quarter, especially in technology stocks up close to 20%, the S&P up close to 15% for the quarter. So, there's expectations coming into earnings are a little frothy. Sometimes it may just mean that earnings turn out fine, but maybe not quite as good as what the market was expecting, and you might get a little bit of a digestion phase. As it relates to Walgreens, hard to parse those macro factors, but if I had to guess, a couple of things that we have seen moderate a little bit recently on the macro stage is that you've seen small business optimism come back in from those sort of record highs we saw at certain points in 2018. Obviously, that has a concomitant effect through the economy. I think people are a little bit more cautious. Consumer confidence is still good, but off of its highs as well a little bit. So if I had to guess, that's probably what that drugstore chain is referring to.
And how do you feel about the overall economy? Because it's like we get good news one day, the next day we get not so good news. Today we got durable goods orders. They were down. One segment was down, but the January was revised up. We got the jobs report coming on Friday. So how are you sitting in terms of the economy?
Yeah. So I think you have to divide it between the U.S. and non-U.S. So on the U.S. side, we're still pretty constructive on the U.S. economy. I mean, if you look at PMIs, which is one of our better forward-looking indicators of what's actually happening in the economy, what we call soft data, which tends to lead the hard data. Most of the soft data indicators in the United States actually look pretty good. Our PMIs are consistently above 50, both on the manufacturing side and particularly on the services side. As you move outside the United States, it gets a little dicier, right? So Europe, certain countries in Europe are flirting with recession. Japan is in a very low growth, low inflation phase. The global PMI is lower than the US PMI, but I would note one thing. Global PMI is actually, in February, they started to turn back up. We're going to get another reading on the JP Morgan one tomorrow. Our best guess is because some of the green shoots we're seeing in China, we actually think global growth is starting to bottom and improve as well, which is, I think, a really good sign for the whole globe.
Great. Thank you so much for joining us.
My pleasure.
That's Chris Constantinos. He's the Chief Investment Strategist at RiverFront Investment Group. I'm Conway G. Gittins, and this is Reuters.